All right, for this video, I want to talk about some potential bonus depreciation traps that can happen when you have income earned in a state and potential depreciation deductions, but that state does not follow the federal bonus depreciation rules. So in our example here, we're going to have a taxpayer that's a Florida resident and has a rental property in New York and needs to figure out what is the impact of claiming bonus depreciation on the federal return, and how would that impact their New York state income taxes? So I've got the tax returns in front of us here. So our taxpayer, Jacob Q. Taxpayer, again, he's a non-resident, so we're filing the IT-398 form. And I've got two versions of this. So one is where we decide to use the bonus depreciation and see its impact on the state level. And then another version where we elect out of using federal bonus depreciation, and then there we can see the impact not just on the state return, but also the impact, if any, that happens on the federal Form 1040. So if we start with the fact pattern, let's go through this, and then we'll jump into the returns to take a look at the actual numbers. So in our fact pattern here, we've got Jacob Taxpayer. He's a single filer and full-time resident of Florida. He works full-time as a consultant and earns W-2 income of $120K. Now, he purchases this single-family home in New York, rents it out to a tenant, and he paid $650,000 for the property and then made some substantial upgrades. So he put $32,000 in upgrades into the property, and these upgrades, fixing appliances, new carpets, things like that, those are characterized as personal property, so they are eligible for the bonus depreciation deduction, right? You don't get a bonus depreciation deduction on the house, but certain improvements you can. Now, Jacob learns that the New York does not follow the federal bonus depreciation rules, so now he's trying to figure out, well, if I claim bonus depreciation on my federal return, how does that impact my state return, or do I just completely elect out of it, right? Now, Jacob also decides that, well, he doesn't actively participate in this rental real estate activity. He has a management company that does all of it. So all of this is going to be purely a passive activity loss if there are losses. And so we're not claiming that active participation allowance, which, if you're familiar with that, at the federal level, you can claim up to $25,000 of passive activity losses from rental real estate activities, assuming you actively participate in the activity and your income is below certain thresholds. Now, the last piece of New York source income that Jacob has here is he flew to New York to do a speaking engagement, and he was paid a fee of $1,500. All right, so now some New York things to keep in mind. Again, New York doesn't follow the federal bonus depreciation rules. So if you do claim bonus depreciation for federal tax purposes, you have to make adjustments to recalculate the amount that is going to be allowed for New York state tax purposes. And this is done by completing the IT-398. And then there's a separate form where we report any additions and subtractions. Okay, so that's what we're going to have a look at here. So let's start with what would happen if Jacob decided to just elect out of using the federal bonus depreciation, right? So in this version, so if we have a look at the 1040, well, actually, let's start with the Schedule E. So Schedule E, this is the Schedule E for the rental property. So we can see we've got the rents, we've got the various expenses here, and the election out of using any kind of federal bonus depreciation yielded depreciation expense of just under $18,000. So if we look at the 4562, we can see this is the $32,000 that would otherwise be eligible for the special depreciation allowance, right? If we did take it, it would be reported up in Part 2, but we've decided to not do that, so we're just depreciating it using the MACRS tables, so it's a half-year convention under the 200 dB method. So only $6,400 is being deducted on these improvements, not the full $32,000. So the Schedule E is showing that if we decide not to elect to use the bonus depreciation, so if we elect out of it, the net loss from the activity is $2,518, which is a passive activity loss. So Jacob has completed the 8582. He's reported the activity with a net loss here on line 2B. And so that because we have a net loss, he is not deducting any of those losses on his return. So Schedule 1, Line 5 shows a 0 for the amount of rental real estate income that is flowing through to his tax return. All right? So that's all good. So now what does it look like on his non-resident IT-203? Well, in his IT-203, the federal amount column on the left-hand side here matches his federal tax return, right? So we've got the wages, the interest income, the other income from the speaking fee. But we can also see here, line 11, we've got a 0 for the amount of losses coming through from the real estate activity because it is a passive activity, so it's being suspended. And so the same thing is applying on line 11, right? We have a net passive activity loss, as we've seen on our IT-182. So we did an IT-182 to report the same. The form mimics the 8582. So no losses on the New York level, no losses on the federal level, and we don't have any New York additions or subtractions here because we don't have any New York state to Fed adjustments, or vice versa, rather. And that's because we didn't claim any federal bonus depreciation. So the only New York source income that Jacob effectively has here is this $1,500. So if we were to go through the motions of looking up the taxable income in the tax tables, what we would find is that the New York State amount down here, $1,500, divided by the total federal AGI of 124, yields a 1.2% ratio, right? So 1.2% of our income is from New York, and so we multiply that by the tax calculated, and the actual amount of tax owed is $83. So effectively, Jacob's not paying any taxes on that rental income because it's at a loss. The only thing he's paying taxes on is that $1,500 speaking fee, which was sourced to New York. So he owes $83. All right. So everything's pretty straightforward there. Now, how does everything change if he decided instead to elect to use the federal bonus depreciation? So this is the new version of the form and the 1040. So 1040, if we go down to Schedule E, this is where we decide we are going to claim the federal bonus depreciation on those improvements. So all the other income and expenses remain the same except for the depreciation amount. So now we've got a deduction of $43,592, and we can see that on our 4562. So now in Part 2, we're claiming a bonus depreciation, 100% of $32,000 on those improvements. So still in a net loss position, right? So we're still in a net loss position. We've got a net loss of $28,118 that is being reported on the 8582 as a passive activity. So by electing the federal bonus depreciation, having only this one activity, only this one passive activity, we still just have a 0 as far as what's being recorded in current income for the year. Right, so none of these losses are being applied against Jacob's income for federal tax purposes. So the net taxable income that Jacob owes at the federal level is 100% completely the same. All that's changed for this year is the carryover amount of that passive activity loss. Okay, so certainly relevant in future years, but at least for the current period, didn't make any difference. Now, how does it change his New York non-resident IT-203 form? The amount of income on the federal side remains the same, right? The wages, interest income, other investment income, line 11 is still showing as a 0 because we have a passive activity loss. The amount of the passive activity loss changed, right? Because we did increase the current year deduction for depreciation. But what's being recorded, at least in the current year, AGI and net taxable income doesn't include any of the rental real estate income, right? And the same goes for the New York State amount, right? So line 11 again is still 0. Here's where we start to see the changes. So in recomputing your federal AGI for New York AGI purposes, you have to make those adjustments for the bonus depreciation. So there's an addition for the bonus depreciation that was claimed, and then a subtraction for the amount of depreciation that we are actually allowed to take for the current year. So the starting point to find these additions and subtractions is with the IT-398. So the IT-398 is for recomputing depreciation expense attributed to the bonus depreciation, right? So Section 168K is the code section that deals with federal bonus depreciation. And so this is the schedule where we compute, okay, well, how much federal bonus depreciation did we claim? How much should we be claiming under the New York depreciation rules? And so we can see here we've got the property, day, place, and service, depreciable basis. The federal depreciation deduction was $32K. The amount that we are actually allowed to claim under the MACRS rules for New York is only $6,400. So the adjustments here are then passed on to the IT-225 form. So if we look at New York's IT-225, we've got an addition here, right? A209 is the code for the bonus depreciation add back. So we've got a $32,000 total allocated to New York. And then on page 2, we've got the subtraction, right? So this is the amount of depreciation that is actually allowable for New York State purposes. And then those amounts are reported up on page 2 of the IT-203. So notice what's happening here. We are adding back a substantial amount of income related to this rental property, which effectively it creates a net profit for the real estate activity, right? If you think about this, we've got $32,000 in income that's being added back, but we're only getting a deduction for $6,400. So we're effectively adding $25,600 of income to New York, simply because we made that election to have federal bonus depreciation. Now, the math looks weird there, and it's because it is. And the reason why this is so problematic is because we're not allowed, even though now we're in, let's say, a profitable state, we can't apply any of the other income or deductions that are attributed to the rental property. So in other words, if we were allowed to kind of go back and do it over and say, well, okay, if you're going to make me not claim the bonus depreciation, at least let me take into account all these other expenses and even add back the rents, that would be fine. But in this case, you're not allowed to do that. You simply just add back the bonus depreciation claimed. You get to deduct what should be deducted for depreciation purposes, and then that's it. So now you're in a position where you have your adjusted New York AGI of $150,000. You have the portion that is attributed to New York at $27,100. So now where the ratio starts to really burn you is down here on line 45. So we can see here now the New York State amount, $27,100, which is mostly just that depreciation adjustment, divided by the federal amount of AGI gives you an 18.06 percentage ratio. So if you take the $87.99 times 18.06, you get $1,589 in taxes. So that is the huge swing, right? So if you didn't take the federal bonus depreciation, you would have owed $83, as we saw in the previous return. But because you claim bonus depreciation and now you have these adjustments, you actually owe New York $1,589. So what's the takeaway here is this is not a one-size-fits-all decision. In looking at this, probably would be good for Jacob to not do the federal bonus depreciation, but you could have different circumstances on the federal side which make you think, well, I should go ahead and just do it anyway. So what I mean by that is, let's say, for example, if we looked at the passive activities, what if Jacob had other passive activities apart from just this one? So if you have other passive income from other activities, by increasing that bonus depreciation, you can now use a greater loss to offset those other gains. And so at the federal level, it might actually save you some tax dollars. In this example, it was a wash at the federal level because you didn't have any other passive activity. But if you had other passive activities, maybe it would have made sense to do this. But in this case, because he's only got the one, passive activity related to this rental property by making that federal bonus depreciation election. It just increases New York state taxes. So again, the teaching point to walk away with here is you have to carefully kind of model this and go back and forth to see what makes sense monetarily. But also keep in mind, all the other activities that you might have as a taxpayer and what it'll look like going forward as well. What will next year's look like? How will it impact your position there as well? So thanks for watching. I hope that was helpful. And as always, I look forward to seeing you again on the next video. Thank you.